Good evening. Nifty nearly erased its opening gap today, but banks, market breadth, and volatility tell us that this was not a durable recovery. The index opened 0.38% lower and came within just 5.5 points of Wednesday's close. It then reversed and finished 0.53% down at 23,870, its fourth straight decline. Participation explains why the recovery did not last. Bank Nifty fell 0.94%, with only 2 of its 14 stocks advancing. Mid-caps and small-caps lost about 1% each, while India VIX rose 1.37%. But this was not indiscriminate panic. Information technology was almost flat, while auto gained 0.7%. Institutional cash flows show a near one-for-one tug of war. Foreign institutions sold a net 2,999 crore rupees, while domestic institutions bought 2,947 crore rupees. Domestic buying therefore absorbed most of the foreign selling in the cash market, but it was not enough to produce stronger banks or broad participation. These are whole-day provisional totals, not a record of who drove each intraday turn. From the macro point of view, oil remained the clearest headwind. Brent moved above $98 as the United States-Iran conflict and risks to important shipping routes intensified. If expensive oil persists, it can raise India's import bill and pressure inflation, the rupee and company margins. Asian markets advanced, so today's Indian weakness cannot be explained as a broad Asia-wide sell-off. The European Central Bank held its benchmark rate at 2.25% as expected, keeping the focus on the duration of the energy shock rather than adding a fresh policy surprise. From the technical analysis point of view, Nifty traded below the 23,840 to 23,920 support zone identified this morning and reached 23,807. It recovered into that zone by the close, but not above it. That weakens the support. It is not a clean hold. The first resistance zone at 24,100 to 24,160 was never reached. Now to options positioning on Sensex weekly expiry. Our public open interest gamma estimate started only mildly positive and close to changing sign. In plain language, it pointed to limited stabilizing pressure, not a firm range lock. The largest nearby put concentration at 76,700 was the key support reference, while 77,000 was the call wall above. Sensex opened below 76,700, briefly recovered it, but failed to hold and closed at 76,391. The support reference helped identify the retest, but public open interest cannot reveal actual dealer inventory or prove that hedging caused the reversal. The three lenses now agree more than they conflict. Oil remains a macro headwind. The technical recovery was incomplete, and expiry positioning failed to stabilize Sensex above its key reference. For Friday, a more durable recovery would need stronger banks, better market breadth, and a softer VIX, not price alone. This is market analysis and education, not investment advice.